Hi everybody, Thomas Moore here at Rebel Income. Earlier this week, the Fed held their monthly meeting. The result wasn't a surprise as they held rates steady, but they modified some of their language from previous statements to indicate their confidence that the soft landing that everybody is hoping for, where economic activity moderates but remains healthy enough to avoid slipping into recession, is on track. What a difference a couple of days makes, huh? On Thursday, the ISM manufacturing report, which is considered a key indicator of product demand because it measures the level of factory orders across the U.S., showed a bigger than expected contraction. That was followed up early Friday morning as the newest labor report showed both an increase in the unemployment rate to its highest level in 2 years, as well as a sharply lower pace of new jobs created. The market finished out the week picking up a lot of bearish momentum as a result. The S&P 500 is down about 5.5% from its last all-time high, which came in the middle of July. The Nasdaq, in the meantime, has led the rest of the market, dropping almost 10% over the same period. Altogether, the mix has been enough to start a lot of people talking about whether any future rate cuts, which now seem to have a high probability of happening next month, are too little too late, and if the Fed is too far behind the curve to actually prevent a recession. Sounds pretty scary, right? Recessions are bad all the way around because people find themselves out of work for extended periods of time, and households feel the pinch of higher costs, restrained budgets, and more. For investors, recession usually means the market is going to drop into bear market conditions that wipe out wealth and erase retirement savings. Is it really as bad as all that? I'm not so sure. I think the latest data is concerning, but I also think it's way too early to start ringing the recession bell. I'm going to show you a few reasons that while I think it's appropriate to think about how current levels impact your investing decisions, I'm not totally convinced that the sky is falling. Before we dive in, I'd like to invite you to support my channel by giving this video a like. You can also help me keep providing new content about how to change your financial life by hitting the subscribe button along with the bell so you'll get notified every time I upload new content. I also have a Patreon page where my free members get exclusive early access to these videos, as well as to my free self-paced investing home study video library, and paid patrons get access to a whole lot more. That link is in the description area of this video, so go ahead and check it out. All right, let's go ahead and dive in. This is a chart of the S&P 500 Volatility Index. This is an indicator that is commonly called the Fear Index because it describes investor sentiment as measured by higher than normal swings in stock prices. It works in opposite fashion of a traditional stock chart. Peaks in this chart represent periods where bearish sentiment or fear is increasing, while the lower ranges typically imply a lack of fear that usually corresponds with broadly bullish conditions. Traditional analysis usually considers any number above 20 as an indicator that fear is high. With Friday's close, the VIX finished above 20 for the first time in 2 years. For a broader perspective, I've marked the last 3 recessionary periods and the bear markets that followed them. The dot-com bust of the year 2000 saw the VIX peak somewhere between 35 and 40. That's a level that was matched by the beginning of the technical bear market of 2022. The Great Recession, which began in 2008, and the pandemic-driven recession of 2020 saw the VIX spike to around 60. So how does that relate to right now? A push above 20 is a bearish sign, but not a guarantee. If you look over the past 20 years, the VIX has seen occasional pushes to 20 and even above that ultimately lined up with nothing more than temporary pullbacks in the broader market. That means concern and a higher level of attention is warranted, but it doesn't rise to the level of panic that a lot of the market commentary out there right now seems to reflect. So let's talk about how to translate broad market action into practical terms. This is a chart of the S&P 500 over the past year. The dotted line running from November of last year to the S&P 500's peak in mid-July highlights the impressive rally the broad market has seen over that time period, and which has pushed the market to one all-time high after another. The thing about upward trends is that the longer they last for either a single stock or certainly the broad market, the more likely it becomes to reverse in the other direction. When a reversal from a high happens, like we have now, you can see that the market has certainly pivoted lower from that high. There are some different methods that we can use to put market declines in context. I've used the trend line from November to July to identify Fibonacci retracement levels off of the index's July high. Fibonacci retracement levels have proven themselves to have a high level of reliability in forecasting where major levels of support or price stabilization can happen when a stock or index starts dropping off of a major high. The first retracement line is commonly called the 38.2% retracement line. The name is less important than where it lies right now. I've identified that line with the orange line on the chart. It sits about 10% below the index's July high at around 5,100. 10% is also the minimum level that analysts generally accept in order to define a market correction. Now, corrections are normal and even healthy when it comes to the market's ability to sustain long-term upward moves. Since the S&P 500 is really only down about 5.5% so far, the market's current drop doesn't rise to the level of correction. It's really just a pullback. That makes the drop so far even less indicative of any kind of continued extended decline. The next line I want to point out on my chart is the blue line, and that's called the 61.8% retracement line. If the market doesn't stabilize around 5,100, then 4,700, which is where that line sits, would be the next most likely level of support. It looks quite a bit lower, since that would mark a decline of almost 17% from the index's July high. That would confirm the market's correction status, but it still isn't enough to mark a true bear market, which is accepted to be at least 20%. Now that 20% mark sits at around 4,500, which I've marked on this chart with the horizontal red line. Even with this week's news then, the market is still a long ways away from bear market levels. That means there's a lot of time as well as distance for investors to digest future data as it comes in. Assuming that the Fed does begin to cut interest rates in September, as most expect, the question at this stage is really whether those cuts provide a lift to the economy and the market, or if they are, as some are beginning to fear, too little, too late. Let's take a look at changes in interest rates over time. To give you some context to the chart that I'm about to show you, I've pulled a list of the rates for Treasury bonds with maturities ranging from 1 month out to 30 years. The first line shows the progression of rates moving from left to right in order in January of 2005. I've used this time period because you can see that the rate increases at an organized standard pace as the time to maturity also increases. This is a pattern that is very typical in normal economic conditions. The second line lists the rates that are available for the same types of bonds as of the end of this week. Now, rather than following the same kind of consistent, organized increase from left to right as maturities increase, notice that the ranges on the left side of the table, which apply to shorter term bonds, up to 1 year in duration, are obviously higher than any of the longer term rates available from 2 years out to 30 years. This is an abnormal situation. Economists like to call it an inverted yield curve. Now, an inverted yield curve isn't categorically bearish or bullish or indicative of economic growth or weakness. But when you look at the patterns of the rates for these different maturities over time, you can start correlating these patterns to changes in market and economic activity. With that in mind, this chart now plots the changes in 1, 2, 5, 10, and 20-year Treasury bond maturity rates going all the way back to 1987. The red arrows that I've placed on the chart apply to recessionary periods. These will correspond with bear market turns in the stock market. The green boxes highlight periods where interest rates have inverted. Now, under normal economic conditions, an organized pattern of interest rates makes it easy to differentiate the rates for bonds on a chart like this, covering different ranges of time. Inversions like we currently have, on the other hand, compress all of those periods together and make them harder to differentiate from each other. Now, alarmists and bearish analysts would use this chart to point out that inversions only last so long, but since 1987, they've always been followed by a recession. What they'll usually dismiss is the fact that rates were highly compressed and occasionally inverted from 1993 until 2000, practically the entire period that covers the dot-com boom. During this time, the economy grew steadily throughout the entire period before it finally dropped into recession in 2000. Rates also inverted in late 2005 and remained that way for nearly 3 years before the financial crisis finally spurred the Great Recession in 2008. Rates even compressed in late 2017, but recession didn't follow for about 2.5 years until the COVID-19 pandemic shut down the global economy. The current inversion of rates has been in place since early 2023. The history of rates over the past 30 years strongly suggests that while a recession may come eventually, the economy could also continue to grow for the next year or more. So what's the conclusion? Alarmists want to say that now is the time to pull your money out of the market, sit in cash, and wait for the inevitable bear market to come. Now, the logical part of that argument is that moving into cash protects you from the variable risk that the stock market comes with. But that's also a risk that's part of the market at any given point. The larger and more important risk, in my mind, of jumping on the panic bandwagon right now is the risk of lost opportunity. Remember that periods of market uncertainty and volatility, and even sharp near-term downturns, aren't automatic signs that a new recession and bear market is imminent. It's appropriate to be cautious and conservative, but to me that means being very selective about taking on new investments, being willing to take profits quickly, and limiting the size of new positions so that your overall risk in any one position becomes easier to manage and analyze in objective terms. Lastly, for any position you take on, you need to think very, very carefully about how you intend to manage or limit loss. When you apply all of those principles, you'll be more likely to keep your money working for you in very practical terms, even while the markets may continue to be uncertain. Thanks for your time, everybody. I hope you found this useful. You can subscribe to my channel by clicking here. And if you'd like to learn more about my Rebel income system, the way that I've developed it to be responsive in any kind of market condition, you can click here. I really appreciate your time. I'm Thomas at Rebel Income, and I'll talk to you again soon.